Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
All right, welcome to the Winner's Playbook. My name is Steve Sloan, the Managing Director of Link Wealth Group. I've got one of our best and senior financial advisors, Billy Norman, on the call today. Billy, welcome.
Thank you, Steve.
How's everything been going for yourself? And I know how busy you are with seeing clients over and over, but what's the latest?
Of course, yeah, flat out. One thing that happened this week, not related to work, but I've got little kids and sometimes they ruin your sleep. And the other night, my 5-year-old burst into the room. I was sound asleep, woke me up, and he was having nightmares. So he said spiders are biting him, the spiders in his bed, all that sort of stuff. So calmed him down, took him back to bed, said, mate, there's no spiders, stop worrying about that. Yeah. Went back to bed. 20 minutes later, he burst in again.
Oh, God.
This time he said, the spiders are back, they're shaking my bed.
Oh, wow. That's
right, amazing. So now I'm getting upset. I've got work tomorrow. You've got school tomorrow. We can't be doing this. Put him back to bed. Get up in the morning, look at the news, and there's been an earthquake overnight.
No way.
Yeah, and I checked the time, and it was the earthquake. Like, it was the exact time that he'd come into the room. And I said, sorry, mate. Your bed was shaking. It probably wasn't spiders, but it was actually shaking. And I showed him the news story, and he was stoked to know that he wasn't imagining things. So.
You have to buy him a gift after that, I reckon. It's false accusations from his father.
That's it. It's another moment when you feel guilty as a parent, but anyway.
What a classic. That's good. I like it. So, mate, working in finance, you've been working in this game for a long time now. You've seen a lot of ups and downs, and we've had to deal with lots of ups and downs. But today's topic, if we're navigating financial crisis, and we get them every now and then, lessons from the past, and as advisors, I suppose we've learned a lot of lessons because we see it all and we see how people react to these financial crises. We'll talk about the ones that happened in the past, and we'll talk about how to deal with it. But what's your take on financial crisis and how we deal with it?
Yeah, it's a good question, and it's relevant at the moment because there's a lot going on in markets right now.
Yeah,
I always think back to the GFC, which was around 2008, because that was the biggest, in the last, several decades probably. It was the biggest event in markets, and there was a huge sell-off in share markets through that period. And there's some really good lessons to come from that. So I always think back to that experience and seeing what works and what doesn't work when you're thinking about what you should be doing as an investor and how you should be reacting. Yeah, how about yourself? Is that
so that's right. Look, I think GFC is obviously the big one, and funnily enough, GFC is when I walked into pretty much an advisor. It was pretty much kicked off as an advisor right at that stage. So it was a very interesting time to walk into the advice world. Before that, I was an accountant, which is very much simple compared to markets. But yeah, it was interesting, and I think I remember the headlines like people losing hundreds of thousands of dollars and people losing their houses through geared loans that they had, and the storm financial issues that everyone saw all over the TVs and people losing so much dough. So it was pretty scary stuff. And look, in a positive manner, it sort of taught me how to deal with negativity straight away, and taught me what the markets can do when they go bad. So I saw that. And I think then the next one was COVID, right? When we sort of fell off a cliff, or everyone panicked and the markets panicked, and some dropped 20-30%. So, but again, I think it was quite fascinating because, especially with COVID, I think that the turnaround of the markets was incredibly quick. I can't remember what the stats were, but I think it was like one of the fastest turnarounds of a market off a significant drop ever. And it just went to show that you can't get out, because the minute you got out, and it was when it turned and came back again. So it happens. It's the way it goes. But you just got to ride it out, right? So, but if we look back at how those two events occurred, if we specifically about the COVID and GFC, how they occur, what made them drop What made the markets drop, you think?
Yeah, look, it's mostly about it's more about sentiment and what investors are feeling and thinking, often more so than the actual facts or what's actually happening in the economy.
Yeah.
That was certainly the case in COVID, right? Because it was just a fear that there's this virus, it's an unknown, and so what will that mean for the world? Well, markets are so complex, and these things are so complex. The lesson from that is we can't predict.
No.
Right? If you said, "Oh, well, there's this huge pandemic, markets are stuffed, people are going to die. Let's sell our investments and hold cash." Well, then if you did that, you missed out on huge gains which followed.
Yeah.
So one lesson is to not worry too much about the media and short-term events when you're investing.
Yeah.
Because you can't control those things, right? So what can you control? You can control where you allocate your money. And that should be driven by your situation, your plan, and timeframes. If you're investing for 1 year, you should not be whacking that money in the share market, because one of these events can come up out of nowhere. But if you're investing for 10 plus years, then you can afford to ride out those downturns, and when one of those crisis events happens, you should just be sticking to your plan. The people that do well through that period do stick to their plan, and in fact, when prices are dropping, and that actually presents buying opportunities.
Yeah, totally. I think it's very clear. I think after being in this game for so long now, you just got to just keep sticking money into it, right? If you're in your 20s, 30s, 40s, even 50s, as long as you've got lots of cash to pay for life, well, you just keep investing, right? Like if that's the way to build true wealth, is just keep investing. You've just got to keep sticking to those markets, keep sticking in growth assets, and then use just time, and as you said, just ignore the noise and just keep going for it. So, mate, if I ask you then, if the listeners are out there and they're a bit worried about this sort of stuff, what can people do to sort of protect themselves around this type of jazz?
Yeah, I mean, there's a few things. Like, one is that you've got a plan, you want to stick to the plan, but that plan needs to be reviewed, right? Like, you don't just set it in place and that's it, I've got a plan for the rest of my life. You review it regularly. And so if markets are starting to make you a bit anxious, time to review the plan. Right? Like, because money that you're allocating to share markets and investments, as we said before, that's got to be that's long-term wealth creation. You still need to worry about the short term in terms of having like a cash buffer and those sorts of things. So one thing you can do is just review your strategy and make sure it's calibrated correctly.
And what about there's a couple of different strategies out there, right, around this. There's the set and forget strategy, and I suppose that's the index fund arrangement where you just put it in an index fund. Don't try and chase the extra yield, like the extra couple of percent. It just sort of sits there and does what it is, and set and forget, if you want to call it that. And then I suppose there's the active approach to investing. Maybe give the listeners out there a bit of an understanding about those two worlds and how that all works.
Yeah, that's a big question too, because there's certainly two camps there. There's a school of thought that index investing is superior and that's the way to go. And there's a school of thought where you should be active around your investments, like picking stocks and trying to beat the market. In my view, and I know yours is similar, a combination of those two approaches is best. Because if you think about it, even if you're investing in indexes, there's loads of different indexes. So you need to decide what combination you're going to put together to build your portfolio. So there needs to be some level of active management. And as markets change, there definitely is some value in knowing how your portfolio is put together and having an element of active in there.
Yeah, absolutely. And what are some of the things you do for your clients, mate, in terms of protecting? I suppose it's all about time, right? Time that you need the money is really the biggest question. When do we need access to that money? That is really the biggest question that needs to be answered by the advisor and the client, because once you answered that question, that can govern how that investment philosophy is structured, and then you don't have to worry about the ups and downs, right? These financial crises, if they happen, it doesn't matter, because if you've got time up your sleeve, it doesn't matter. But give us a bit of an idea about, a couple of your clients in different age brackets. How would you go about structuring up different clients at different ages in terms of their investments for these types of issues?
Yeah, great question. So, I mean, for clients who are early in their wealth building phase, the investment selection is less critical. Like you can just get away with some basic indexes that are tracking the share market. The
Yeah.
thing you need to be focusing on is getting money into the portfolio, right? So making sure you're on top of cash flow, you've got money to add to that investment every month. That's your main focus.
Yeah.
As you get closer to like some level of retirement, so you built up the asset, now you're getting to the point you want to take the income or draw down on that.
Yeah.
That's where the investment selection becomes a lot more critical, because once you're retired, you have less ability to ride out. Like if there's a big crisis or a downturn, you're not working anymore. So you can't just like keep investing through that.
Yeah.
You need to preserve your capital. So that's when you need to be far more active.
Yeah.
And the sort of things we're doing at the moment for those sorts of clients, like in retirement, interest rates are higher than they were a few years ago. So there's actually a lot of opportunities to earn really good income in low risk investments. So with those sorts of clients, we might be pulling back a bit on the share market and looking more at like term deposits, mortgage funds, bond funds, all those sorts of things. And there's loads of different options.
Yeah, like those mortgage funds you just mentioned, I've seen some pretty nice returns on those at the minute for some cash. What are some of the cash rates you can get on some of those mortgage funds for your older clients?
Yeah, I mean, one of the ones we're using, which is one of the biggest funds in Australia, that's yielding over 7% at the moment.
Right.
And that's quite a low risk fund with a long track record.
Yeah.
So it's certainly it's tough for young families at the moment, but for retirees, if they've done well and they're sort of like self-funded retirees, there's actually some very good investment opportunities at the moment.
Yeah, no, definitely. And tell me this, so if people want to get a bit more educated around how markets work and the ins and outs of markets, and what do they do if the markets fell over 20%? Where do people go? Where do they get this information?
Where do they go? Yeah, that's a tough one, because there is loads of information online and it's not all good information. So it really is hard to find quality info. I mean, some of the best advisors in Australia, like the guys we've got in our group, put out some awesome content online, and we hear that regularly from clients that they find that to be really valuable. So, just looking at some of the top advisors in Australia, the podcasts and the content that they put out, there's some really good information there.
Yeah. So where they go to just, I think you're all over TikTok, aren't you, mate? All of your stuff is pretty much TikTok and LinkedIn.
Yeah, we love TikTok.
Love TikTok. So, say we're structuring up a client, you've got a 15-year gap between now and retirement for that client. What's some of the messaging? What would you be telling a client around these financial crises and the ups and downs of the markets? How do you approach it?
How do I approach it? Yeah, there's a few things. I mean, it is scary for people. Like you see what's in the media, it's all this doomsday stuff, or you see the market drop 3% in one day. It is scary, right? Because it's your money.
Yeah.
It's never nice to see the value drop.
Yeah.
So there's a few ways we go about it. The first one is to zoom out. Like the media is focused on what's happened today, right? But when we're investing, if we've got 15 years, that's a huge time frame. So the first thing is to zoom out. We look back at past downturns, look at what markets do over the long term, and come back to the basics of investing, which is if you're investing in the share market, you are buying shares in the world's biggest and best companies. They grow their profits over time. That's what causes share prices to rise.
Yeah.
Over short time frames, there's obviously huge fluctuations, but over the long term, those share prices rise. That's why we're doing it.
Yeah.
That is always going to beat cash and inflation by a big margin.
Yeah.
So we need to be investing. And if we don't need to touch that money for 10 plus years, we don't need to be concerned with short-term fluctuations.
Yeah. So what you're saying there, markets go up and down. Over time, they go up more than they go down, which is good. And it's just about continuing to invest when you got time up your sleeve. Sounds about right.
Yeah, spot on. So if you're investing for 1 month, the share market is very risky, right? And cash is very safe.
Yeah.
But if you're investing for 10 years, cash is very risky because that will lose value, and the share market is very safe.
Yeah. Good way to put it, right? So for those listeners out there, then, and this is probably something as advisors we know a lot about, but when we look at investments, we look at two things. You got your capital, and then you got your income. Maybe explain a little bit about those two worlds and why they're very important working together.
Capital growth versus income.
Yeah.
Yeah, so look, in the share market, I know historically, a lot of retirees in Australia used to invest for income. So they'd just buy banking shares, buy shares in Telstra, that sort of thing, because they pay big dividends. But the issue there is you're often sacrificing growth when you do that. Because if a company is paying out huge dividends, it means they're not reinvesting in the growth of the company.
Mm-hmm.
So you may not see share price growth.
Yep.
So for me, when I'm investing in the share market, I just want the best total return. I want, growth plus income. I want the best total return. Yep. So personally, I don't worry too much about income versus growth when it comes to stocks. It's different if you're investing in direct property. Right, the yield is important because you might need to be funding a debt on that. You might need to be paying off a loan with the rental income.
Yeah.
With the share market, personally, I just worry about total return.
So people out there listening might think that's a bit crazy that you're not worried about income, right? So like, how could you invest in something if you're not worried about income? But explain that. What is it about that you just said why is that so important?
Yeah, so if you've got that, if you're just accumulating wealth, so you're just wanting to pump money into the share market every month, you just want the maximum possible return over time.
Yeah.
So whether it's growth or income, to me, it doesn't matter too much.
Yeah.
If you are in retirement or if you've got a share portfolio and you're wanting to draw down on that, that's when income does become a bit more important. But I would focus more on income producing assets. So like bonds or fixed interest, term deposits, mortgage funds, those defensive assets, the yield is really important. The income's really important.
Yeah.
With the share component, again, to me, the total return is most important because if you need to draw down on stocks, you can easily click sell. Right? It's a liquid asset.
That's right. Yeah.
So you don't need to just take the dividends.
Yeah.
You can make adjustments periodically and make sure you've got plenty of cash and you've got that regular income stream.
Yeah, there's a lot to be said about investing on a stock market, right? Because you can sell it, it's liquid, and you can get your money back. It's as simple as that. So that's very good to know. So, and then we speak about emergency funds, whether it's called emergency fund or just cash in the bank that you can use. How does that differ between someone's in their 20s and 30s to someone in their 50s and 60s? Or what's the difference there, and how much should each of those age brackets generally keep in cash?
Yes, it does differ, Steve. There's a few factors that determine how much you ideally have in a cash reserve. Right? Yep. If you are young and living in a share house, you don't need a big cash reserve. If you have a young family, you need a big cash reserve, right? Yep. Because you've got, what do you need a cash reserve for? One thing is like unexpected medical costs.
Bills,
yeah. And if you've got a whole family, including kids and everything, and and pets,
and dogs,
then there's lots of people and animals in that house that might have unexpected medical costs.
Yeah.
If you own a house, things can go wrong with the house.
Yeah.
If you've got a house and two cars, there's potential costs that can come up.
Yep.
So in those situations, you would want quite a significant cash reserve. If you are fully retired, you don't necessarily need a big cash reserve because you have full access to your superannuation.
Yeah.
And you can take an extra drawdown there if you needed to.
Good points, mate. Good points. And say I'm a new client coming along, and I want to know how, and I'm going to consider Billy Norman as my financial advisor. How do you invest your money, mate?
How do I invest my money?
Yeah.
Well, I invest it the same as what I recommend to my clients.
Yep.
Share market's a no-brainer. Everyone needs money in the share market, right?
Yeah.
Regardless of your situation, because you can start small. It's cheap. You can largely set and forget.
Yeah.
So absolutely need shares, and within that, you want Aussie shares, overseas shares. You want diversification.
Yep.
Index funds, maybe some active funds. So definitely have shares. I use something called an investment bond for my kids. Again, that is share market exposure, but it's a product that has a special tax treatment on it. So it's really good for kids' investments. Recently acquired investment property. Now for clients, like an investment property is a big undertaking, so it's not necessarily for everyone, but ideally if you can fit it into your strategy, an investment property is also a good thing to have. And aside from that, I'm a shareholder in a financial planning business as well.
Perfect. And looking at that, that's probably a very, very well diversified investment portfolio, right? Because you've got the best of all worlds in there. You've got the share market, which is liquid, if you need the cash, but still growing. Investment properties or properties that can, big assets that can grow over time. And then you've got business interests, which obviously you can, and you are working in the business, you can control that to some way, shape or form to how that's going to perform. So to me, and I say this to all clients myself, I think if you can get all of those asset classes in your investment portfolio, you probably ticked all the boxes, right? I can't see anything else that we're missing there.
Exactly. It took me a long time to get there, Steve, but I've ticked all those boxes now. So now I just need to work hard and build those things up.
Yeah, same. Well, that's great, mate. I appreciate you coming on today, Billy. Look, for those listeners out there, you can get this podcast on Spotify and Apple. Rate us a 5-star. It helps us out a lot. You can check us out in the show notes. And there's actually, if you go to linkwealth.com.au, you can book in any one of our advisors for a chat about your own situation. And there's a newsletter that you can subscribe to through there and also through the show notes and LinkedIn. Billy, thank you for your time, mate. That was very educational. I appreciate your time, mate. And we will see you on the next one.
Awesome. Thanks, Steve.